And let's turn to the latest on the markets. The U.S. government shutdown led to the country's latest CPI data seeing a delay. We should now expect those latest numbers on Friday. Our next guest thinks the data may come in slightly more inflationary than the market currently expects. We're joined by Mike Vinokur, portfolio manager at Propellus Wealth Partners at AI Private Wealth. Mike, thanks very much for joining us.
Oh, pleasure to be here.
Lots to talk about, lots going on. Can we touch on the TSX and what it's doing today? Your thoughts on that?
Sure. Well, as you said, what goes up sometimes comes down. In this case,
you phrased it differently. It goes up on an escalator, sometimes
down on an elevator. Right. Well, you know, sometimes we feel like the euphoria of making money is not as powerful as the fear of losing. Right. And so you get those kinds of reactions, both to the downside and the upside. But in the terms of the TSX, we've seen the mining sector and the materials sector this year explode to the upside. The jubilee that people have felt in the gold market and the copper market, platinum, palladium, I mean, name it, metals, silver even. It's been very extreme, one might say, to the upside. And now you're seeing potentially a little bit of air coming out of that balloon. Does it mean that it can't reverse and go back to the upside? No. But this is healthy because hockey sticks that only go up one way usually blow up an even bigger disaster at some point in time in the future.
So you kind of like seeing this, actually, a little bit of the air.
Yeah, I think it's healthy. I think it's healthy because I think that sometimes you need to have a little bit of a correction as a pause to reset the decks.
Now, what is a little bit of a correction to you?
Well, typically, if you look back in history, 3 to 10%, nobody should be surprised, even in a bull market. Depending on how quickly it happens, sometimes it feels like it's a lot more than 5 or 10%. But really, when you peel back the onion and you look back at a chart, say, over a couple of months, it's a blip. But understanding where you are in the market cycle, understanding where you are in the credit cycle, understanding the interchanges of currencies, commodities, interest rates, and how all these flows affect all these different markets and asset valuations is very important.
And now, but it's been an up and down over the last few weeks, especially with the market. Is this another of the down, and then we'll bounce back up?
Well, if I had a perfect crystal ball, I would tell you for sure.
I'm going to put you on the spot for a second.
Right. Well, generally speaking, at least in the North American markets, when you've had such a strong equity market for the first 3 quarters, generally the fourth quarter is a good one. How good, we don't know. But from a technical perspective, we are starting to enter in a couple of weeks the period of seasonal strength, which typically happens from the end of October into April. So if this year is like past history, maybe not exactly, but it will rhyme, even if we have some kind of a pullback, which we think would be very healthy right now, we think that then the pendulum swings back the other way and you see momentum and flows to come back in. So we would argue that should we see a decent sized correction, it is a buying opportunity.
Okay, and let's look south of the border. What are you looking for down there?
So we like a lot of unloved places in the market where we think things are trading at multiples that are well below the market multiple. And the market multiple today, of course, is driven by AI craze and technology stocks. But when you look at an industry like healthcare, right? Think about Pfizer, think about Merck, Bristol Myers Squibb. You know, a lot of these companies have not gotten a lot of love in the last year or two, be it for political reasons, be it for other reasons. But we think that some of these businesses are very strong businesses. They have a lot of good core cash flow, lots of great dividend yield, steady balance sheet. And look, we're in an aging demographic. So you got to believe that healthcare is going to be one of those industries that's recession resistant, dare I say. And perhaps with some innovation from AI, maybe they can cut their costs, increase the pace of innovation, and increase profits. So one of the companies that we like a lot down there is Merck. We think Merck is very well managed, has a great balance sheet, has a good dividend yield, very cheap on a price to forward earnings ratio in our view at less than 11%. You know, you could see by the chart, it has not gone up a lot from the low point at Liberation Day. The stock was much higher in yesteryear. We think that the valuation doesn't ask a lot of investors at this point, and we see a lot of upside if they can execute on their drug pipeline.
And with the health companies, what are you looking for with the earnings season right now?
Well, we think the earnings season is going to be good because we think that it's pretty much status quo in the U.S. and internationally. There has been some chatter about, drug pricing coming down, but we think that in one way, shape, or form, there's always been discounts between the pharmacy benefit managers and all these administrators of health plans, and therefore the actual margin cut to the companies may not be as acute as one may think.
And a bigger picture, it looks like the government shutdown in the U.S. may be wrapping up. They may have a deal this week. It means we should see some data. What are we expecting from the data we're going to see? Likely, I think it's on Friday.
Well, so we were supposed to get the inflation report, I think, last week.
Yeah.
Because of the shutdown, it's been delayed. Now, this is going to be backward-looking data, so it's going to come out on Friday, October the 24th, and this is a September number. So we're 3.5 weeks into it. We surmise that based on where commodity prices were, where input prices were, and a whole bunch of other factors, that perhaps the CPI comes in a little bit harder than expected. And if that's the case, will that sway markets on what the Federal Reserve is likely to do and how that may move interest rate markets? We think that it could be a catalyst for a correction, but at the end of the day, it's not going to deter market participants from coming back into the market.
Okay, and regional banks, I think people breathing a little easier on those ones. It seems, Zions was the one that I think a lot of people were concerned about. It seemed to do okay with the earnings.
We have to be careful,
okay.
Because as many people have said in the past, the cockroach theory, there's never just one, typically.
It's taking on a life of its own, that one, isn't
it? So you've seen one bank, Zions, Western Alliance, you've seen another few blemishes here and there. I'm not sounding the alarm yet, but one must look at some of these metrics to say, where are we in the credit cycle and what dangers may be looming.
Okay. Mike, thank you very much for joining us as always.
Pleasure to be here. Thank you.
Mike Vinokur is Portfolio Manager at Propellus Wealth Partners with IA Private Wealth.